Your paycheck hits your account every month, and somehow, by the end, there's barely anything left. You work harder, earn more, yet building real wealth feels impossible. Meanwhile, you watch asset prices soar beyond reach while your savings lose purchasing power. This isn't bad luck. This is by design. The modern financial system operates on principles that systematically channel wealth upward while keeping the majority trapped in cycles of earning and spending. Today, we're going to examine how this system functions, why traditional advice often fails, and what history teaches us about protecting our financial future. Let me start with a number that should shock you. The bottom 50% of Americans own just 2% of total wealth, while the top 10% control 76%. This isn't ancient history. This is today. And these numbers have been accelerating, not improving, over the past several decades. But here's what makes this particularly important right now. We're living through the largest wealth transfer in human history, and most people don't even realize it's happening. During recent economic disruptions, billionaires saw their combined wealth increase by nearly $4 trillion, while millions of families struggled to cover basic expenses. This wasn't coincidence. This was the system working exactly as designed. The foundation of this system rests on debt. American household debt has reached over $18 trillion, a figure that's grown by more than $4 trillion since 2019 alone. But debt isn't just a number on a balance sheet. It's a mechanism that transforms your future labor into someone else's present profit. Consider how this works in practice. When you take a mortgage, you're not just buying a house. You're entering a 30-year contract to transfer a significant portion of your income to a financial institution. The average homeowner will pay more in interest than the original purchase price of their property. This means that over the life of the loan, you're essentially buying the house twice, with the second purchase going entirely to the lender. Credit cards operate on an even more predatory model. The average American carries over $6,000 in credit card debt, paying interest rates that often exceed 20% annually. At these rates, making minimum payments means most of your money goes to interest, not principal. A $5,000 balance can take over 20 years to pay off with minimum payments, costing more than $11,000 in total. But the debt trap extends far beyond individual borrowing. The system actively encourages debt through what economists call artificial scarcity. Housing prices have been inflated through zoning restrictions, lengthy approval processes, and financial policies that favor speculation over home ownership. Education costs have skyrocketed because easy access to student loans removed natural price constraints. Healthcare expenses have ballooned partly because insurance systems obscure true costs from consumers. This creates what researchers call the wealth extraction economy. Instead of generating new value, much of our financial system focuses on extracting value from existing productive activities. Financial institutions profit from the spread between what they pay savers and charge borrowers. Real estate investment firms buy properties not to improve them, but to collect rent from people who could otherwise afford to own. Insurance companies collect premiums while finding reasons to deny claims. The predatory lending industry exemplifies this extraction model. Payday lenders target communities with limited banking access, offering short-term loans with annual interest rates exceeding 300%. These aren't emergency services helping people in crisis. They're wealth extraction machines designed to trap borrowers in debt cycles. Research shows that 75% of payday lender profits come from borrowers who take more than 10 loans per year. Car title loans follow a similar pattern. Borrowers use their vehicle as collateral for loans they often cannot repay, leading to vehicle repossession in 20% of cases. This means people lose their primary means of transportation to work, making their financial situation even worse. These practices disproportionately impact communities that can least afford them. Predatory lenders concentrate in areas with higher poverty rates and larger populations of people of color. This isn't accidental. It's a deliberate business strategy that extracts wealth from vulnerable communities while claiming to provide financial services. The system also operates through what economists call rent-seeking behavior. This occurs when individuals or companies increase their wealth by capturing existing value rather than creating new value. Financial speculation, where investors profit from price movements rather than productive investment, represents a massive form of rent-seeking that diverts capital from productive uses. Stock buyback programs exemplify this dynamic. Instead of investing in research, development, or worker wages, many corporations use profits to purchase their own shares, artificially inflating stock prices. This benefits shareholders and executives with stock-based compensation, while doing nothing to improve the underlying business or benefit workers. Real estate speculation follows similar patterns. Investment firms purchase properties not to improve housing stock or reduce costs, but to profit from artificial scarcity. This drives up housing costs for everyone while generating returns for investors who contribute nothing to actual housing production. The result is an economy where asset prices rise faster than wages, making wealth building increasingly difficult for people who depend on earned income. Those who already own assets benefit from price appreciation, while those trying to acquire assets face ever higher barriers to entry. This dynamic explains why traditional financial advice often feels inadequate. Suggestions to save more, spend less, or invest in index funds assume a system where wages keep pace with asset prices and where market returns reflect productive economic growth rather than monetary manipulation. But when the system itself changes the strategy's rules, traditional lose their effectiveness. Central banks can manipulate interest rates to zero, making near savings accounts worthless while inflating asset bubbles. Governments can print trillions of new dollars, diluting the purchasing power of existing money, while claiming its necessary stability for economic. This brings critical understanding us to that most people miss. The modern monetary system operates differently than most assume. When banks make loans, they don't lend out depositors' money. They create new money electronically, backed primarily by the borrower's promise to repay. This means that most money in circulation exists as debt, with interest obligations that exceed the total money supply. Think about the mathematical impossibility this creates. If all money is created as interest-bearing debt, where does the money to pay the interest come from? It can only come from new loans, creating more debt, requiring more interest payments. This isn't a flaw in the system. This is how the system maintains perpetual growth in debt levels. The implications become clear when you examine monetary policy during economic downturns. When crisis strikes, central banks respond by lowering interest rates and increasing money creation. This provides liquidity to financial markets while doing little for people who depend on wages. Asset owners benefit from inflated prices while workers face higher costs of living without proportional wage increases. Recent economic disruptions demonstrated this dynamic perfectly. Emergency monetary policies supported stock markets and real estate values, while millions of people lost jobs and businesses. The recovery primarily benefited those who already owned assets, widening wealth gaps rather than closing them. Education debt illustrates another dimension of this extraction system. Student loan balances have grown exponentially, not because education became more valuable, but because easy credit allowed institutions without to raise prices constraints market. Students graduate with debt that often exceeds their starting salaries, beginning careers already they're trapped in payment cycles. The psychological impact of this system extends beyond financial stress. When people struggle despite working and hard following conventional advice, they often blame themselves rather than recognizing structural problems. This keeps them searching for individual solutions to systemic challenges. Financial media reinforces this misdirection by focusing on personal responsibility, while rarely examining how monetary policy, regulatory, and rent capture-seeking behavior shape economic outcomes. Stories about people who succeeded through exceptional circumstances become templates that ignore the mathematical reality facing the majority. Meanwhile, those who understand system mechanics position themselves differently. They acquire assets that benefit from monetary expansion rather than holding currency that loses purchasing power. They structure their finances rather than suffer to benefit from inflation from it. They recognize that the rules favor debt when used to acquire appreciating assets while punishing debt used for consumption. Understanding these dynamics doesn't guarantee success, but ignorance guarantees failure. The gap between those who recognize how money actually flows and those who follow outdated advice will only widen. Knowledge becomes your first line of defense against a system designed to extract value from your labor. The rules aren't hidden. They're just not taught. If this opened your eyes to how modern finance actually operates, subscribe for more insights into the economic forces shaping your financial future. This content is for educational purposes only and does not constitute financial, legal, or investment advice.